Good morning, everyone watching live here on BAM YouTube. Let me know in the comments which market you are tuning in from today. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will discuss minutes from the Federal Open Market Committee, a $2.3 trillion decline in home equities, reduced mortgage insurance premiums, and jobless claims, which was just released at 8:30 a.m. today. This is Thursday, February 23rd. I am Byron Lazine, and the hot sheet starts now. Hit the thumbs up if you'd like to support this show. Consider sharing it with one person who wants a 24-hour look back on the housing market. If you were just on my Instagram live and you came over to, let me know in the comments if you were over on that Instagram live. Appreciate you popping over here to the YouTube. Okay, the Fed Minutes show members' resolve to keep fighting inflation with rate hikes. So we know that the Fed meeting happened on January 31st and February 1st. We covered that here on the hot sheet. We're covering all things right now that are happening, obviously with the economy, and certainly watching the Fed very closely as they try to fight inflation down to their target of 2%. And we covered Jerome Powell's speech at that time. Okay, and so that was this meeting here, this January 31st through February 1st. On February 1st, we were able to get that speech from Jerome Powell, and we were able to cover it the next day, right? The meetings come out usually 2 to 3 weeks, about 3 weeks after. And yesterday, the minutes from that meeting were released yesterday. Okay, so we're going to cover the meetings. We're going to cover the minutes here in a second. My big three takeaways. The next meeting will be next month, March 21st and 22nd. Okay, and then the minutes would be 3 weeks from that. This link, as all of our links are down below, so you can grab all of our sources, all of our slides in the daily download. Okay, let's go through my three big takeaways here from the minutes. And it's a big PDF, but that'll be obviously down below as well, so that you can download that and read through that and get all the takeaways that you'd like. Okay, so the raise to the target range for the federal funds of 25 basis points, which we know happened last meeting. All participants agreed that it was appropriate to do that. Okay, so many of the participants observed that a further slowing in the pace of rate increases would better allow them to assess the economy's progress towards the committee's goal of price stability. And obviously they want that 2% of inflation. Okay, so many of the participants in the committee observed that they should go into a further slowing of the rate hike. Okay, so that's what we saw with this 25 basis point, that we're slowing down. We're not ramping up the interest rate hikes like we were last year, okay, for the federal interest rate. Okay, interesting. A few participants stated that they favored raising the target range for the federal fund rate 50 basis points at this meeting, or that they could have supported raising the target by that amount. The participants favored a 50 basis point increase, noted that a larger increase would more quickly bring the target range close to the levels they believed would achieve a sufficiently restrictive stance. Obviously, the St. Louis Fed chairman, he was on yesterday at CNBC saying we should go to a 50 basis point hike. He wants more substantial hikes instead of this wait and see approach where we're doing the 25 basis hikes. A lot of people think that out there still that we've already done enough and we should just pause and wait. It does appear that the Fed is going to continue to increase. We'll see on this next meeting what they do with the information they've had from that January 31st, February 1st meeting, and then to the next meeting. We've had nothing but hot inflation data come out, hot economic data. So when they met, and we're reading the minutes now, 3 weeks later, since that time, when, all this information we're reading from the minutes, we've had all of these hot reports. So are they going to go into that March meeting now and say, we need to go to a 50-point basis hike? We know that as the Fed kept ratcheting up the interest rate last year, the bond markets responded. The bond markets have been responding to all of these hot economic data reports that I'm referencing right now. And that's why we've seen it get all the way up. We're going to reference the 10-year here at the end, to close to 4%. So if they go 50 basis points, that could push this, perceived recession that much quicker, and certainly the bond market will respond. Some participants judge that recent economic data signaled a somewhat higher chance of continued subdued economic growth with inflation falling over time to the committee's longer goal of 2%. Although some participants noted that the probability of economy entering a recession in 2023 remained elevated. Okay, so the probability of the economy entering a recession this year remain elevated. That was one of the discussions 3 weeks ago in their meeting. Here's my biggest takeaway, and this was the most bearish stance that the Fed committee had in their meeting 3 weeks ago. This right here, this housing take was their most bearish stance. The staff judged that asset valuation pressures remained notable. In particular, the staff noted that measures of valuations in both residential and commercial property markets remained high, and that the potential for large declines in property prices remained greater than usual. So a lot of markets have seen a 10% decline in prices up to this point. There are a lot of rural and suburban markets that haven't seen a 10% decline. And certainly at the median price point and below, that would remain true as well. But overall, there are many major markets, we've covered that on past hot sheets, that have seen close to a 10% decline in prices. The Fed is still saying that these values have remained high. So even if you're in one of those markets where you've seen 10% decline, they're saying the valuation is still high. Why? Because you had a 40% increase the 2 years prior from peak. From peak now to where we're at today, you had a 10% decline, but you're still up 30% in 2 years. So that is a high valuation. But what they're saying is that significant declines, in their words, large declines in property values remain greater than usual. They didn't say this about the stock market. If you read the minutes, the stock market, they believe, has priced in a lot of what is coming. The Fed doesn't believe housing values reflect what is coming over the next 10 months. So if the home values in your market, and let me know in the market what's happening for you right now in your market, if in your market home values have not declined yet, or maybe they're just off maybe a point or two, okay? What the Fed is saying, expect a decline in the future. Expect in 2023 for there to be significant price pressure. We are experiencing an extremely volatile situation on the mortgage interest rate. We were at 5.99 3 weeks ago. Now all of a sudden we're staring down at 7% again. Every single day, data changes, markets react, bond market reacts. We are in times like no other where it's day-to-day changes, day-to-day data consumption. How far are we going to be able to push inflation down? All of these things are being considered every single day. And there will certainly be, in almost every market in America, a reaction to price going forward. We saw 15 to 20% correction from April of last year to January. That's Steve and Christine. Which market? Let us know which market you're referencing there. Okay, let's move on to what Redfin has just reported is a significant drop in home equity. Okay, so if we haven't seen it in pricing, Redfin is saying we're seeing it right now in equity. The housing market correction has already caused homeowners to lose $2.3 trillion. Reading from Fortune, a Lance Lambert piece just released yesterday. For 124 consecutive months, spanning the bottom of the housing crash in February 2012 through the top of the pandemic boom in June 2022, U.S. home prices posted growth every single month. Okay, of course that streak has ended. We spoke about that earlier this week. But on Wednesday, just yesterday, Redfin published a report finding that the total value of U.S. homes have fallen $2.3 trillion since the start of the home price correction last year. The total value of U.S. homes was $45.3 trillion at the end of 2022. down 4.9%, 2.3 trillion from a record high of 47.7 trillion in June. That's the largest June to December drop in percentage terms since 2008, writes Redfin. So let's be clear. This is only, there's certainly a home price correction rolling through many markets nationwide. Most homeowners are still up big time, right? And that's the big takeaway. If you're talking to a homeowner and they want to know, where's my value? I bought 2.5 years ago. Where's my value today? Well, you're still up a lot. Okay, you're doing quite well. You're down maybe on average 4 to 5% in any given market. You're okay. They're talking about 4.9% in equity being lost. That's equity, right? So that's not the necessarily the value, sure, according to Redfin, but you're up big. Now, if you're a seller in 2023, being a seller right now is much better than being a seller at the end of the year. The sellers today in quarter one are going to make more money than the sellers at the end of Q2, the sellers in Q3, and the sellers in Q4. I want to be a seller right now. If I'm a home shopper, I do want to be working with an agent that's preaching a little bit of patience, because the trend line right now is that values are dropping. This chart, along with all of our sources, down in the daily download link below. U.S. home prices are falling for the first time since 2012. So look at this trend is just starting. Excuse me there. The trend is just starting, if you can see that line. I don't think it's going to be prolonged like, 2007 to 2012. There's no indications that that's going to happen, but the trend is just starting. So maybe it hasn't caught up to my market yet. If I'm a home shopper, I need to take that into consideration. I need to practice a little bit of patience. As these interest rates are being extremely volatile right now, that takes a couple weeks to catch up. I believe that this weekend rather, open houses are going to be less trafficked than last weekend's. Why? Because we're closer to 7%. It takes a week or two for these things to kick in. People locked in a couple weeks ago to a lower rate. Now, all of a sudden, some home shoppers might throw in the towel for this weekend. What the heck? Let's wait, see what happens with the rates. I think open houses will be a little less traffic on average across the country than they were just last weekend, and certainly the weekend before that. Okay, that this is just a psychology of what's happening right now in the market. Okay, so a home shopper might want to be patient looking at this chart. And then, here's another shift in home value chart. If you're in the West, let me know in the comments if this is the same thing you're seeing, that there's a significant shift in home values. It hasn't hit the Northeast. It hasn't hit middle of America that much. Okay, there's certain pockets, but it hasn't hit in a significant way yet. Now, there's a lot of belief. We're going to cover this tomorrow. I've got a Fannie Mae and Mortgage Banker Association report just from this week and some projections on the 30-year fixed. There's some projections that the 30-year fixed is going to go down by the end of the year. Typically in a recession, KCM, Keeping Current Matters, does a great job reporting this all the time. Typically in a recession, the 30-year fixed is going to go down. The 30-year fixed mortgage rate is going to go down in a recession. So if we get a recession, which the Fed noted in their minutes, okay, if we have downward pressure on prices, on home values, and then we have an interest rate that's going to go down, if I'm a home shopper, do I want to practice patience right now? I probably do. It probably looks better for me in the second half of the year if I'm deal shopping. If I'm lifestyle shopping, need a house now, kids are driving me crazy, whatever's going on, it is what it is. I got to find the perfect house, perfect community. Am I going to be there 7-10 years? It doesn't matter if that's the case. Okay. What matters to home shoppers in the lower price range right now is affordability. And the Biden-Harris administration just yesterday announced a reduced mortgage insurance premium to help with that. This is on nowbam.com. Biden administration has announced an action to save home buyers and homeowners with FHA insured mortgages $800 per year by reducing mortgage insurance premiums. Home buyers and homeowners with FHA insured mortgages will soon have this average of $800 per year savings. Vice President Harris and the Department of Housing and Urban Development Security Fund announced today that HUD, through Federal Housing Administration, FHA, will reduce its annual mortgage insurance premium by 0.3% from 0.85% to 0.55% for an estimated 850,000 borrowers in 2023. We had a quote here from Greg Schwartz, CEO of Tomo Mortgage, former Zillow exec, says bringing down the hard fees and costs to buying homes will allow millions of Americans to build wealth and prosperity through home ownership. This is the American dream in action. I've been a little bit, I've been like, hey, what's going on here, DC? Why are you just making it easier for people to rent, right? You made it so easy for developers to go out and build multifamily home. We have an abundance now of inventory of multifamily home. We've got Wall Street buying up single family homes. All we're doing is making it extremely hard for people to buy that starter home, to actually start the American dream that Greg spoke about, to build wealth and prosperity through home ownership. If I can rent and it saves me $500, $600, $700, $800 a month versus my mortgage, like we just talked about the other day on the hot sheet, then I might have to rent this year because those dollars matter. Well, this action saves $800. So it's a step in the right direction. The president of National Association of Realtors, Kenny Parcell, he validates that. He supports this measurement. I haven't spoken to a lender yet that doesn't support it. And so this is a step in the right direction here to try to make home ownership more affordable. Now, we're sitting at a really low spot for inventory, and we know that there's already high competition for median price point homes and below, and we don't have inventory coming, and we've got Wall Street looking at those homes. So does it create a more competitive environment for those home shoppers? Yeah, you could argue that it does. We need supply. We know we need supply. Agents, go get some supply for this market. It's the biggest impact you can make on your community is getting more supply, which is going to help with affordability as everything shakes out that we just talked about throughout the year. Okay, we also had today at 8:30 a jobless claims report that just came out, and the GDP second read. So we talked about the GDP just a couple of weeks ago. That came in at 2.9%. It was above the expectation of 2.8%. And typically, the Fed wants to see this right now, not in the negatives, but not below expectations. They did a second read on that today, and it came in at 2.7%. So a little bit cooler than initially thought here on the second read. That is, it's not bad news. It's not going to change it too much, but it's better news. Okay. Jobless claims though edged lower last week. So the jobs market remains hot. Okay. So they had job claims decreased 3,000 to a seasonally adjusted 192,000 for last week. The Labor Department reported this morning. Weekly claims have remained below the 2019 pre-pandemic levels of 220,000 since the start of the year. The expectations were that we were going to be at 197,000 jobless claims. We're at 192. You might be saying, Byron, why do you want people to lose your job? I don't. The Fed does. Okay. I like it when these numbers keep going down. I like the fact that we're at our lowest unemployment rate in 40 or 50 years, lowest level since 1969, 50 plus years, right? I like that. I want people working. I think people should have a job. The Fed wants their job to be easier. And so they actually want to see this number go up. And there's a lot of economists that believe they want this number to go up over 300,000. Okay. So that'd be, 100 plus thousand. We know that the job market right now is very, very strong, which is going to be one of those factors that potentially push against what the Fed said in their minutes that we just covered, which is an elevated risk of going into a recession or elevated possibility of going into a recession. What continues to remain elevated right now is the 10-year yield. Okay. All these hot economic reports and inflation reports the last couple of weeks has pushed up the 10-year Treasury note considerably. It was up just a tick this morning before we started the show. Let's take a look at where it is right now. It's down a tick. Okay. So that's good, but we are above 3.9. And we know that when we get to that 3.4 level, that's when we can start looking at a 5 handle on the 30-year fix. We are well away from that. We're a full half a point away from that. And we'll see where it goes the rest of the day. Yesterday, it was kind of flat. And what did that do to the 30-year? It put us up just a tick My expectation was that we had a chance of being flat or maybe even a little bit lower because we were down a tick at the start of the show from the day prior of 6.875, but in fact, we went up to 6.88. So we are staring down the barrel here at a 7 handle on the 30-year fix. The psychology of a home shopper, of somebody looking to buy a home, even in this spring market where seasonality upticks and people buy more homes right now, the psychology of 7% interest rates certainly is not good. We've seen the mortgage applications decline the last couple of weeks, and that's just in line with the 30-year mortgage rate going up. Okay. Today we've got a walkthrough premiering at 5 p.m. Bobby, I don't know if we've got anything in the comments that I should address with the limited time here that I've got. If we do, you can flash it on the screen. In Boise, we know Boise has been hit really hard. We know Boise's been hit really hard. Home values are down 16% since May of 2022. In fact, there's some reports that Boise, Idaho is one of the hardest hit markets across the country. Price is still declining, but our inventory remains low. Okay, so if somebody is trying to get out, they had a huge pop in home value. I was just talking to an agent on my team, actually in Connecticut, has a relative in Boise, and they were thinking about selling. Well, they just bought last year. So they're in like that tight window where things, kind of hit that peak and then started dropping. But there's certainly a belief in Boise being a market that went so over hot and you can tell me if I'm wrong, but there's a belief that Boise still has a ways to go before they hit bottom on pricing because they got over hot during that time frame of the pandemic. Okay. Question to those on the call or who or what segment, this is from Steven, of your consumer base is being hurt by the Fed's policy? Listen, I'll tell you right now who's being hurt by the Fed policy. It is lower income folks in your community. It is people that are trying to buy that starter home. Okay. The Fed's policies have pushed up the 30-year fixed rate considerably. What have those policies not done? They haven't brought more inventory to the market in most markets. Okay, so you've got a situation right now where their policies printed so much cash, and you put all these homeowners in a position to have 3%, 2.75%, 2.5%, 30-year fix. You think they want to sell those homes? No. You think they've got any incentive to move up? Not at a 7% interest rate. So you've got this Cold War that I've been talking about forever, where sellers and buyers are both kind of sitting on the sidelines. We've seen that in the transaction decline. There's considerable transaction decline, obviously, since the last couple of years. And so who's been hurt? It's been those lower income earners, somebody who wants to stop renting and get into home ownership. You're at 7% interest rate. You're at valuations that are still near those peak levels, where we saw 40% gains the last couple of years, and you've got low inventory. Okay, so that's who's getting hurt the most. People with a lot of money aren't getting hurt that much. And so let me know in the comments if you agree or disagree with that here on the live chat. And certainly if you're watching the replay, leave me a comment there as well. Those are two different comment boxes. Okay, tomorrow on the hot sheet, we're going to definitely get into this Fannie Mae home price outlook, this Mortgage Banker Association outlook. They've got some predictions on where they think the 30-year fixed is going to go. I'm going to dive into that and more tomorrow. We've got the walkthrough premiering on this channel today live at 5 p.m. Make sure you're subscribed, and I'll see you guys all tomorrow. Until then, toodaloo.